Thank you, Glenn. Good morning, everybody. By a show of hands, who here has been in the financial service industry for more than 5 years? Okay. Keep those hands up. More than 10? More than 15? 20? 25? Amazing. 30 years? Amazing. I've been in the financial services industry since 1999. In my 25 years, the one thing that I have discovered is that permanent financial plans require and need life insurance. It is the main character. All other products are supporting cast. I was a financial planner from 1999 to 2016, and like Glenn, I started my career at CIBC. I was a financial planner for 2 years, and I realized that my employer was my greatest competitor. And so I decided to leave, and I went with a small brokerage and started building my portfolio from there until 2016. In 2016, I realized I was unhappy with my position. I built up a beautiful portfolio. I was about 65 million in assets under management. I was getting paid very nicely. But what I realized going to work one day, I was very unhappy. And I was unhappy because I realized that the financial advice that I was giving to my clients were not creating wealth. Who was getting paid? All the time. 2008, when markets went down 35 to 50%, I got paid. I never had a year where I didn't get paid, but clients had losses. And in 2016, I realized I can't do this anymore. I am not creating wealth for my clients, I'm creating wealth for the banks. The plans today focus more on product and they minimize the need for life insurance. And I know because I was that guy for 17 years. I focus strictly on product because this is what the banks and financial institutions teach you. Focus on product. We're selling mutual funds. We're focused on product. There was no discussion of life insurance. And so traditional planners today are setting their clients up for failure because these plans focus and rely mostly on what? Wall Street, right? Bay Street. If you want to test that validity, there's a book out by Fred Shrewd. He wrote it in 1955, and it's called Where Are the Customers' Yachts? And the summary of the book goes like this. A tourist is in New York, and he's walking by the marina. And he's with a tour guide. And the tour guide says, look at all these beautiful yachts. And the tourist says, who owns those yachts? He says, oh, those are the big bankers of Wall Street. And the tourist says, well, where are the customers' yachts? He laughingly says, the customers don't have any yachts. Only the bankers do. Shouldn't the customers also have the yachts if they are taking the advice from these brokers and bankers? But they don't. It's all the big Bay Street boys and Wall Street guys. They're the ones with the yachts. Let's play a game. I want you to think of one product. If it was legislated by law that you can only have one product in your financial plan, I want you to write down what that product would be. Would it be real estate, gold coins, rare stamps? Would it be a mutual fund? Would it be a stock? Maybe precious metals? I want you to write down what that one product would be. And that product must have some features, characteristics. One of those features should have a systematic plan for money to get into it. I always say to my clients, if I was to drive my car from Toronto to Florida, Don, you drove from Toronto to Florida, right? How many times did you have to fill up for gas? 4 times. You didn't fill up in Toronto when you got all the way there, right? No. He had to stop 4 times to fill up for gas. So the plan must have a systematic flow of money to get into to be a success. True? I can't fill up once in Toronto and then make it to Whittier, Florida. I can't coast there. And the money that goes into that plan should have a return on it. The money that goes into that plan should also minimize taxes on the growth. That money should be available to me at any time without penalty. It should also have minimized taxes on the distribution of that money. And there should be ease of distribution of that money. Another characteristic, it should contain a contingency on death. Should also minimize losses. A skillful plan minimizes losses. They don't increase losses. When I was a financial planner, I would sit with a client. Who is aware of a KYC? Everybody know what a KYC is? Okay, for anyone who's doing investments, it's called the Know Your Client. And before I put a financial plan together, I had to sit with a KYC and go over to the client and ask him, what is your risk tolerance? Please describe risk to me. What rate of return would you like to get on your money? Client would always say to me, I want to get 10 or 12% on my money. Great. What is your aversion to risk? I don't like risk. Well, we have a disconnect here. Because if you want to get 10 or 12% return on your money, you must be willing to accept higher risk. Then the client says, okay, I'll take on the higher risk. And today I would say to those clients, if I was on the other side of that desk and a financial planner told me that, I would say to them, I'd say, so let me understand this correctly. In order to get a higher rate of return, I have to take higher risk? Yes. So what you're actually saying is, for me to increase my chances of winning, I have to also increase my chances of losing. True? Who wants a plan like that? I don't. I do not want to increase my chances of losing just to get a higher rate of return. So a plan should not increase risk, but minimize the risk. It should also be flexible to change at any time. A good characteristic of a financial plan should also become self-funding should I become totally disabled. Anybody putting into RSPs? How many clients do you sit with that are putting into their RSPs? Glenn, how many people do you sit down and you see that, what are you currently doing today for your preparing for your financial future? RSPs is like top of the list, right? Have you ever said to a client, if you became totally disabled, will the government of Canada continue to put in money into your RSP? No, they won't. So a plan should become self-funding if you became totally disabled. And if a plan contains any less of one of these characters, it would be less than ideal. Now let's compare that to any of the products that you wrote down. Compare any of the products to permanent life insurance, and let's see if it remains keeping all of the characteristics. I'm here to tell you that there is not one product, if you put side by side to permanent life insurance, it will retain all of those characteristics. Therefore, a plan containing one or less of these characteristics would be less than ideal, right, Mr. Client? Do you want to have a plan that loses some of these characteristics? And the client always says, no, I do not want to lose any of these characteristics. Therefore, permanent life insurance can stand alone in a financial plan. If a client were to only put all of their money into permanent life insurance, they would be a success. They may not have the most amount of money, but they will be a financial success. Who here watches baseball? Anybody baseball fans here? Okay. I got a chance to meet Alex Rodriguez last year. He's one of the greatest baseball players for the New York Yankees. I met him in Toronto at the multifamily conference. One thing Alex Rodriguez said, he was congratulated on being one of the greatest all-time home run leaders. But you know what came with that too? He was also known for having the greatest strikeouts. So while a lot of these financial planners are trying to hit home runs for you, they're not going to get you to the Hall of Fame. Permanent life insurance will get you to the Hall of Fame. If on death, the permanent life insurance policy would pay out to their family, and their family would receive maximum benefit. While he's alive, he gets to enjoy the living benefits. One of the things that Glenn showed in his illustration is that permanent life insurance is contractually guaranteed to give you a policy loan. These are unstructured loans. Does everybody know the difference between a structured loan and an unstructured loan? Put up your hand. Do you guys know the difference between structured and unstructured? A structured loan is when you go into a bank and they tell you what the interest rate is going to be, what the terms of the contract are going to be, and what your monthly payment is going to be. And you have to agree to all of the terms with the bank to get this loan. What are some of the other things you have to do to get a loan? You gotta have a job, right? Good credit score. You gotta qualify. And how do you qualify? You gotta have a job. You need good credit. You have to show your ability to pay it back. An unstructured loan, there is only one known variable, and that is what? Interest rate. That's it. That's all you need to qualify. You just have to know the interest rate. It's contractually guaranteed. They can't say no. So during your lifetime, you get to access this money guaranteed. I'm going to give you a little quick story. In May, I was in Las Vegas with my wife. I'm also a real estate broker. I'm a real estate investor. and I'm a mortgage broker. In May, I'm in Las Vegas with my wife, and I have a client's listing for a condo in a building. And I wasn't getting a lot of showings, and I couldn't understand why, because I thought it was priced right. It was a 3-bedroom condo. It was priced at $589, over 1,000 square feet. It was a great area in Mississauga. So I went on the MLS. I was just, let me see what's going on here. So I go on the MLS to take a look if there's any new listings that actually came up. Sure enough, one new listing came up 2 days prior. Exact same model. It was a 3-bedroom condo, over 1,000 square feet, and this guy had it listed at $459. I said, something's wrong here. I'm listed at $589, this guy's listing at $459. I'm thinking, this thing's gotta be a piece of shit. Sure enough, I see the seller says estate sale. I'm like, love this. I used to be a builder 10 years ago. I was a custom home builder. And all I bought were estate sales. Why? Because I could close quickly on them. I might not have the best offer, but I had the best terms. So I called the seller, the real estate listing agent, and I said, hey, can you tell me what's going on with this condo? And he said, sure. My uncle died. He had no children. He left it to my mother. There's no mortgage on it. It needs a lot of work. They just want a quick sale. She wants to get rid of it. I said, tell you what, I'm going to make you an all-cash offer, and I'm going to close in 10 days. He says, send me the offer. So I made an offer for $440,000, all cash, close in 10 days. He came back to me, we settled at $450,000. Who here keeps $450,000 in their bank account? Nobody? I don't. You'd be stupid to. I have 3 life insurance policies. I started, my first one when I was 21, my second one was 35, my third one when I was 45. I got a policy loan for $450,000. That's how it can close in 10 days. I filled out one piece of paper. I put my policy number on it, how much I wanted, I attached a void check, I signed it. In 10 days, I had $450,000 in my bank account. I sent it to my lawyer, I closed in 10 days. I stole this condo for $450,000. The very next day, I had my general contractor in there ripping everything out. Ripped out the kitchen, ripped out the bathroom, ripped out the floors, ripped out everything. I put about $50,000 into the condo. I sold it 90 days later for $550,000. Paid back my life insurance plus a little bit of interest, and I walked away with about $45,000 in my pocket. Life insurance gave me that ability to close on real estate in 10 days, to do something that I did not have to apply for. It was contractually guaranteed. And I can give you guys other stories of how I used my life insurance to even complete homes that we ran out of money on. I couldn't get any more money from a bank. I just went to my life insurance policy, borrowed against it, finished up the home, sold it, paid it all back. The financial plan should also avoid market risk. There's no fluctuations. Imagine you being retired and you are depending on an interest rate from your money and the market loses 20%. Traditional financial planners today talk about what? Accumulate, accumulate, accumulate. True? How much money do you need to save to get to retirement? What's that goal? Client says, I want $1 million. How did you come up with that money? Traditional plans today are focusing on what clients say they need. I need $1 million in retirement. Great. Because the safe withdrawal rate, does anybody know what the actual safe withdrawal rate today is? Sorry? 3%. 3% is the safe withdrawal rate. So if you've got $1 million saved up in your RSPs or TFSA, congratulations, you're a millionaire. But you're going to be living in poverty. Because you're relying on a 3% withdrawal rate. So if you got $1 million sitting in RSP and you're pulling out 3%, you're getting 30 grand a year. After tax, you're probably sitting around 25, 26 maybe. You are living below the poverty line, but you're a millionaire on paper. This is the problem with today's financial plans. Traditional planners are focusing on accumulating money when we should be focusing on acceleration of money, creating velocity. Plans today do not focus on accelerating, but the banks do, right? Do banks hold on to money? No. They take your money and they rent it back out, and they create velocity, and they do this over and over and over again. They don't hold on to it. So why are we not doing what the banks do? We need to be accelerating and creating velocity with our money. Permanent life insurance also gives you the ability to have a guaranteed income for life, tax-free. You are able to collateralize your policy, get a line of credit against 90% of the cash value at mortality, and that income is for life or till age 90. Can they tax loans? No. It's tax-free. That's why also I love real estate so much. Because I don't need to sell an asset. I can leverage that asset and get tax-free income. This is why people hate guys like Donald Trump. Guys like who don't pay tax. Well, they just know how to use the tax codes in their favor. They leverage real estate. And they pay the least amount of tax. There is no other product that can play such an important role without losing one or some of the characteristics. What is the goal of a financial plan? The goal of a financial plan is to what? Maximize benefit and money supply simultaneously without giving up one for the other. And when we do that, when we maximize benefits with money supply, we are creating what? Maximum financial potential. Isn't that the goal for every client, is to create the maximum financial potential? What do traditional plans focus on today? What are they focusing on? Maximum money supply, true? They forget about the maximum benefit. And if you want to test the validity of that theory, Glenn touched on it. They say, buy some term insurance, invest the difference. So while they're trying to focus on the money supply, they're giving up the benefit by buying term insurance. I'm here to tell you, folks, that plan's going to fail. 98.9% of term policies will not pay out. Why? It gets too costly. Glenn said it. Term insurance is the most expensive insurance that you're going to pay for. Why? Because you keep paying it for 40 years. And then you get to a point where it becomes too costly and you end up canceling it. Now you have no insurance. You didn't lose the premiums for 40 years. You also lost the opportunity cost of what that money could have earned you had it in an account earning you 5%. And if you take a look at that amount of money, permanent life insurance looks pretty cheap. I always say to my clients, the most important life insurance is the one that is in effect the day you die. True? If I said to a client, Mr. Client, I've got a great mutual fund for you. I've got a great stock for you. But here's the thing. There's a 99% chance that you're going to lose all your money. Do you think that client would still buy into that mutual fund or stock? No. But go listen to Dave Ramsey. He seems to think that term insurance is the way to go. But what he's not telling you is 99% of the time, it's not going to be there. Because what are you doing? You're making a bet with the life insurance company that you are going to die within that period. I'm sorry, but that's not a bet that I want to win. Insurance companies are not stupid. They know how to price these products. Just take a look at the 10-minute life insurance, the lesson on life insurance. It goes through and it shows you how they price it. They price it for profitability. In term, well, you just got to look at the actuary tables. It's really cheap in the beginning, but it gets really expensive in the end. I'm not saying term life insurance doesn't have a place. It has its place, just not for life. I always add a term policy rider on every whole life insurance I buy. Why? Because we are taught to do what's called a needs analysis. And if I'm doing a needs analysis, 9 times out of 10, the amount of permanent life insurance, that client cannot afford it. So what I'm going to do is I'm going to look at the affordability, get some permanent and say, hey, let's get you the right amount of coverage that if something were to happen to you, your family's not going to suffer. We're going to replace your income for the next 20 or 25 years. But here's the other really great thing too. As your income goes up, as you start earning more money, I guarantee you, when you start seeing your savings account start to grow and you're not losing money, you're going to want to put more in. I can convert some or all of that term into permanent life insurance without having to do a medical. Just a year ago, my best friend, who I started in the home building business about 10 years ago, we did one life policy. And we started off doing this policy because he was buying dump trucks. It's a funny story. He was buying trucks. He had a demolition company. He had several trucks. And I said, hey, Jay, how much are you spending on these trucks? And he says, each truck's costing me about $200,000. I said, and how do you pay for it? Well, I got to apply to MAC. They charged me about 7%. I got to make monthly payments. And I said, do you want to learn how you can be the bank? Instead of going to MAC, I'm going to teach you how to be the bank, and you're going to do this on your own. He said, yeah, I'd love to learn that. So I showed him how to maximize permanent whole life insurance by overfunding, putting a set amount of dollar in, and after 4 or 5 years, he would have had enough money built up that now he no longer has to go to MAC. He could do this himself. And the other problem that he had too, and a lot of business owners, put your hand up, anybody working with business owners here? What is one of the biggest problems that business owners have? When they want to find or finance a piece of machinery, what did the banks want them to do? Sign a personal guarantee. I'm a mortgage broker. I see this all the time. I've got a business owner trying to buy a house. And I say to him, what's this lien on your credit bureau? Oh, that's from my company. Company pays for it. Yeah, but did you sign a personal guarantee? Yeah. You're pooch, man. Because the bank is going to look at this as if your company doesn't pay for it, you're personally liable, and now I have to include that monthly payment in your ratios, and I'm sorry, you no longer qualify. Yeah, but my company pays for it. I understand your company pays for it, but you made a personal guarantee. I've had to decline so many people or had to put them into what's called a B lender, pay a higher rate or put more money down because the ratios didn't fall in line because of this lien they had. Well, now guess what? My best friend, no longer has this problem because he now has had a policy for over 10 years. He's got a ton of money in there. Every time he wants to finance a piece of machinery, he does it himself. John, I need 90,000. John, I need 300,000. Buys a piece of equipment, and when that machine starts making money, he pays the whole thing back. So I put a term rider on for $1.5 million 10 years ago. In January, he called me up. He says, hey, can I do another policy? My company is really making a ton of money right now, and I got to get some money out of my company. I said, yeah. We don't have to do another policy. Do you remember 10 years ago I put that term rider on? I said, how much money do you want to put in? He says, I want to do another $10,000 a month. I worked the numbers out, and it just seemed that the $1.5 million worked out to be about 10 grand a month by covering it over. And I didn't have to do medical. He says, okay, do I have to go to the medicals again? No. Why, how come I don't have to? I said, because you were approved 10 years ago. It's already done. We just converted. In 5 days, I had a full conversion into his whole life policy. Now the company's putting another $10,000 a month into it. So I always add term onto a whole life policy to meet the insurance need of the client, plus also clients are always going to want to later down the road, as they earn more money, to be able to put more money in, and at least you don't have to write a new policy. So it does have its place. Another reason why buying term and investing difference does not work, and Glenn touched on this. People aren't disciplined enough. They are not disciplined to put that difference away every month. Why? Walking through the store, oh, I need a new pair of Jordans. Oh, look, Louis Vuitton's having a sale. I got to get that purse. I'm going to forego putting the next 3 months of payments away. Buying term, invest the difference, you're going to fail. So how do I get my clients? I talk about this with every client. I always talk about what are the characteristics that you want. And how I do this is, number one, has anybody seen the confidential questionnaire inside Circle of Wealth? There's a 4-page confidential questionnaire. I send this to every client. So when a client wants to do a meeting with me, I give them 30 minutes. That's it. They go into my link tree on my Instagram. I'm very active on Instagram. I've got about 27,000 followers on my Instagram, 35,000 on TikTok. If no one's on TikTok, you might think, oh, that's for kids. I'm going to tell you something. My wife got me on TikTok. She says, you need to get on TikTok, and I'm going to tell you something. I made over $300,000 last year on TikTok. No bullshit. I picked up one client who had a twin sister, and we did a lot of business together because they didn't trust the banks, and they started watching all my videos. I do a lot of wealth building videos, small tips. So TikTok, I have a huge following. LinkedIn, my YouTube, I have a podcast. But in my bio is a link tree, and you can actually book a 30-minute consultation with me. And in that 30 minutes, a couple of my questions and say, you got 30 minutes. Why did you reach out to me? What financial situation are you in? What are you going through right now that made you book a 30-minute call with me? And I let them talk. The other thing I ask them is, what is your belief about money? I want to know what their thoughts around money are. I had a call just 2 days ago. I said, what is your belief about money? He says, well, I want to help my family. I said, great. He's getting married. He makes a lot of money. He's in the construction business. He left as an employee, started off as an employer, hired a couple guys. He's in the concrete business. In his first year in business, he said he did about $290,000. He plans on doubling that next year. He says, I've got a ton of money coming in. I watched your wealth building videos. I need to talk to you. You're the guy I got to talk to. I said, great. If you want to work with me, I have a 4-page confidential questionnaire for you. Right now, we're talking at a 30,000-foot level. I need to come down to about 100 feet. I'm going to send you a 4-page confidential questionnaire. You can get it off Circle of Wealth. I'm going to send this to you to complete. If you send it back to me, it tells me that you want to work with me. If I don't get it back for you, it tells me you're not serious and we can end this call right now. John, I'm going to get it to you. Great. I sent it to him in the morning. By the afternoon, he had it filled out and sent back to me. I've had clients where I have sent it to them, and I've had to follow up with them a week later. Hey, just want to make sure you got that questionnaire. Did you get it? Yeah, I'm really busy. Too busy to prepare your rich life? Some of them don't send it back. I make 2 calls, 2 follow-up. That's it. I'm done. It tells me you're not interested, and I am not interested in working with you. So once I get that 4-page confidential questionnaire back, I tell the client, we're going to have another conversation. Now we're going to get down to that 100-foot level. And that's when I pull out the 10 questions off of Circle of Wealth. And I go through the 10 questions with him. I want to understand what their idea of retirement, what are they currently doing now? What has been their experience in working with another financial advisor? What keeps them up at night? Then I do something else. I have another piece of paper, and on that at the top it says wish list. And if the client is in front of me, I will take that and I will pass it to them and I'll give them a pen and I'll tell them, this is your wish list. I want you to write down everything that you want. It's a bucket list. I'm going to tell you something. The first 5 things, I can pretty much tell before they even write it down what they're going to put down. It's always monetary value. Oh, I want a Ferrari. I want a new sports car. I want a cottage. I want this. I want that. And then let's go further. I want to know more about you. You're seeing me because you want me to put together a financial plan because up till now you've been unsuccessful. So let's talk about that financial plan. I want you to write it down. In your financial plan, do you want to have a plan that has no risk of loss? Yeah, write it down. In your financial plan, would you like to have guaranteed rates of return? Yeah, write it down. In your financial plan, do you want any government involvement? No. I tell them write it down. In your plan, do you want your plan to grow without incurring tax? Do you want your plan to pay out tax-free? I go through all of the benefits of what a permanent life insurance policy does. That list that Glenn put on the board, I asked these clients, in your plan, are these the things that you want? Yes, write it down. Then I hit them with this. Mr. Client, if I come back to you with a financial plan that meets all of your criteria, is there anything stopping you from moving forward with that plan? And I get them to commit to me right there. I haven't even given them a plan yet, but I'm getting them to commit. I'm going to tell you something. I have never had a client say to me yet, well, no, I'm not going to commit. You just told me everything that you want. If I come back to you with a plan that gives you everything, is there anything stopping you? I'm going to tell you something. 100 out of 100, they say, no, there is nothing stopping me from moving forward, but I don't think you can do it. Oh, you just told me I can't do it. I love it even more. And then I come back with the plan. But how do I design that plan? I go into the spending game. And I take all of the information that's on that 4-page confidential questionnaire and I plug it into the spending game under present situation. And then I take a look at what are they currently doing? How can I plug their financial leaks? Where are they transferring money unknowingly and unnecessarily? How can I find the money? and I do a suggested plan. I also go a little step further. I ask clients for their last 3 months' credit card statements and their banking statements. Well, why do you want that? I want to see the crap that you're spending money on that you don't need. I did this with a client last month. She's 22 years old. She makes good money, still lives at home. I said, Taylor, I want you to send me your last 3 months' banking statements. I want your credit card and I want your bank statements. I want to see what you spend money on. So I want to do a little exercise. So she sent it to me. And I called her up, I said, what's all this Amazon shit? She says, I love Amazon. Every time I get on Amazon, I'm always buying a hoodie or buying something else. And then, oh, because you bought this, other people bought this, they paired it together, and then I'm always buying this. How much money do you think we found in 3 months, 90 days that she spent on Amazon? I kid you not. It was just shy of $8,000. I said, I found $8,000 for you. I'm not asking you to put all of it into an investment. Could you put half? She says, yeah. I said, even though we want to prepare for our future lifestyle, and these are the words of Don Blanton, we want to make the journey along the way fun and exciting too. True? Yeah. I don't want you to put it all into it. I want you to still live and have some fun. But you don't need to eat out every day. You don't need to buy 10,000 hoodies. She was very happy to save at least 50% of that money, on top of what she already told me that she is comfortable in putting away. So if a client really wants to work with you, I get their 3 months banking statements, credit card statements, and I go through and I start finding where they're spending money, because these are the things that they're spending, and it's just getting, because they think, oh, I'm going out to eat, it's only $12, or it's only $10. Yeah, but it's 30 times a month. You're spending $400 on eating out, and you don't need to. Start preparing food at home. It's always these little amounts of money they're spending that they don't think about, but it adds up. And she said, I'll tell you the one thing that we did this exercise together. She says, I feel sick. I can't believe when I put it together, I spent almost $8,000. I feel sick. This is how we find lost money. We have to justify our needs and our wants. I have a system. It's called the 50-30-20 rule. I tell my clients, take 20% before you pay even CRA, before you make any payments. I want you to take 20%. I want you to put that away. You're going to learn to live off 80. The 50% is for your fixed expenses, and the 30% is for your lifestyle. Lifestyle would mean dining out, entertainment, that sort of stuff. Your fixed expenses is your mortgage, your rent, your utilities, your phone bill. Learn to live off 80 and always put 20 away. Once you start to get into that routine and that habit, you'll see it's not that hard. You will adjust your lifestyle. I talk about this in my upcoming book. I've got a book coming out at the end of March. It's called Wealth Without Wall Street. Taking back control of your money in a rigged financial system. I talk about the 5 laws of money. One of them being is pay yourself first. But if we are not finding the money for the client, and Don talks about this is what Circle Wealth is about. We got to find the money. There's 3 types of money, right? How many times, I do this with clients, I sit down, I said, do you know the 3 types of money? And they go, no. I said, you've got your savings and your accumulated money, you got your lifestyle money, you got transferred money. And if you were sitting with a traditional financial advisor today, what is the number one focus on money that advisor is going to have? Is your savings and your accumulated money. What are you currently doing now, and what do you have? Because to a traditional planner, it's all about the numbers. How much assets can I gather? Because traditional planners get paid on what? Assets, right? What do you currently have? And if you don't have much, they're going to focus on your lifestyle. So I say to the client, how much time do you want to work with a financial advisor showing you how to take more risk with what you currently have saved to achieve a higher rate of return? And the answer always is, I don't want to spend very much time doing that. Now you're going to work with a planner who's going to focus on the lifestyle money. How much time do you want to spend with a financial advisor showing you how to reduce your current lifestyle so that you can put more money up into your savings and possibly taking higher rates, higher risk in your portfolio? Well, I don't want to spend much time reducing my current lifestyle. At that point, the conversation is dead with a traditional planner, true? They don't have a need for you anymore because they're focusing on one other aspect of the money. It's the transferred money. Where are you spending money unknowingly and unnecessarily? How do we find it? For Taylor, I found $8,000 that she spent in 3 months. That's just over $2,500 a month I found. We got to find the money. And the circle of wealth, if you go through the system and you use it, it shows you how to find the money. And then I plug it all into the spending game. And when I sit with a client, I say, Mr. Client, here's what you're currently doing. And if you continue on this road, this is what your retirement is going to look like. You want to have X amount of dollars. We always look at 80% of what you're currently earning. Well, you're going to see there's a huge deficit here. Or you're going to run out of money by 77, but your life expectancy is 85. Now here's the plan that I found. Without changing your current lifestyle, I was able to find the money that you were transferring away, and we're going to put it up into these plans. We're going to look at some permanent life insurance. We're going to build up the safety in the tanks. And by doing so, by learning how to accelerate the money and learning how to replace that 3% safe withdrawal rate with a guaranteed income, which is the cash flow, and it's non-taxable, well, guess what? Using the spending game, I've got the 2 illustrations. I've just now showed him the suggested plan, and he's not going to run out of money. Which plan do you think that client's going to go with? The current present situation or the plan that I'm suggesting? The plan that I'm suggesting. Why? Because they are never going to want to win a race where they're outliving their money. Nobody wants to outlive that money. That's just a race that nobody wants to win. And so what I love about the spending game is I can show them where they're deficient between the present plan and the suggested plan. The system will also allow, if they currently have RRSPs, TFSAs, non-registered investments, I can go into the life insurance, the cash flow from the life insurance. I can also select which one I want to melt down first. And the system, the calculator, allows you to do that. And it shows the tax. When you're playing with the boxes, I could show the taxes that are being taken off and the cumulative. Because a lot of times people don't know, they're not aware of the taxes that are accumulating over time. And when they see that, I guarantee you they're going to feel nauseous. They're going to feel ill. So you could play with the system and allow you to show all the taxes that they're paying. And you can show it with the present plan, and then here's my plan. So really get familiar in using a spending game, because in my presentation, after my couple meetings, I'm going to sit with the client, and that is the exact system that I'm going to use, is the spending game. Present situation, my situation, it answers it for itself. And then I come back to the client and I say, Mr. Client, let's go down the list. Did I accomplish everything that you wanted on your wish list? And we go check by check by check. You told me, you gave me a verbal commitment, you told me that if I was able to give you everything that you wanted on this plan, you would move forward. We still on the same page? Yes. All right, let's get the documentation going. This is how I close my clients. Last year, end of 2023, I wrote just shy of $1 million in annual premium. 2024 is going to be even bigger. Any questions? Thank you. Yeah, so I started a podcast a couple of months ago. It's called The Wealth Easy Show, 𝐒𝐍𝑌. I talk all things wealth, health, and real estate. So you can find it on Spotify, all podcast platforms. On YouTube, you could actually find it it's under my name, John Durbano, and you'll see all my podcasts. I bring a lot of different guests on. I'll bring accountants on. I'll bring lawyers on. I'll bring life insurance guys on. Real estate, health practitioners, because I say, it's one thing to be wealthy, but you still also need to be healthy too, because it doesn't matter how much wealth you have if you're not healthy mind, healthy body, healthy spirit, the wealth means nothing. And I truly believe in creating wealth through real estate and through whole life insurance. And I talk a lot about it in my upcoming book, using real estate and whole life insurance to create wealth. Anybody got any questions? No? Guys, thanks so much. Enjoy the rest of the conference. I know, anybody here for the first time? Oh, wow. You guys are in for a real treat. If there's one thing I love, I'm going to be honest, I know Don's in the room, so I'm going to float your boat a little bit, Don. I was actually really disappointed when a few years ago when Don decided to kind of relax and he brought in Mark Guthrie, and unfortunately Mark passed away and Don came back in. And I'm really happy to see Don back, because there's nothing more than I love than listening to Don speak, because he's just such a wealth of knowledge. Congratulations, Don, for 30 years, Circle of Wealth. So you guys, this is a really great place to network and meet people. There's a lot of people here from the US, but we all share the same commonality, is that we want to create the maximum financial potential for our clients. And it's really good to network and get to know people and just absorb everything. And you guys are going to love listening to Don. I know I will.